And I just want people to start thinking as it relates to every decision you make has a consequence. And again, I feel like a broken record here, but we want people to understand that money is a tool. Loans can be a tool. Anything, any financial instrument can be a tool to better live your life. And if you don't have clarity on what that looks like, that's more important than, figuring out the best way to buy a car, because maybe you shouldn't even buy a car because buying that car might not get you closer to where you want to go. This is Better Wealth with Caleb Guilliams. All right, everybody, welcome back to part 2 in how I bought my Tesla using life insurance. This is actually going to be on mostly on my computer, and we're going to have some calculators pulled up. If this is the first video that you're watching, please go back to my part 1. I talk about why I bought the Tesla, the 2 areas of any time you make a purchase, whether it's a car, a house, an airplane, or whatever, how to go through that process. And then I actually spoke through like big picture these 3 scenarios of paying cash, using leverage, and then ultimately using the and asset and the bank, which I think is a phenomenal way to do that. And so what I'm going to do is I'm going to go over to my screen here. I'm just going to pull up one other thing. And okay. And you're going to see me in the corner. You're going to see some calculators, and you're going to see the 3 areas. And essentially, real quick, is anytime you make a purchase, you got to first of all decide, do I want to make the purchase? If that's the case, then obviously what's the most efficient way to do that? I'm making the assumption that you already have the money, because I would not recommend buying any depreciating asset. Depreciating asset is something that goes down in value if you don't at least have the money for that. The only thing is a mortgage or as a house, and it's common that houses go up in value, but that's not like hard and fast the law. That's like the one exception that I would make. So, all right. So pay cash for that car. In my case, that was a Tesla. So in that example, this was $65,000. Now, the benefits of paying cash is you don't have to work with a bank, you don't have to pay any interest, and you get it done quick. So you have the Tesla, you have no interest. A lot of people, including Dave Ramsey, would say, great job, you win, you're amazing at life. How I see it is I look at, and you can see this in calculator above, I look at $65,000 and I ask the question, okay, what would be the bare minimum that I could earn over my lifetime? Now, being an entrepreneur, being an investor, being into money, I can earn a lot more than 5%. But if we're just baselining like, hey, over the next 30 years, I'm going to earn you 5%, I'm pretty confident in this, especially since I get a lot of opportunities. And just if you look at a low index of the market, this should be very attainable. It's again, asterisk, but you have to come up with this rate of return. Maybe you're less confident or more confident. That goes into this equation. Let's say you could earn 5%. That $65,000 that you paid for the car, you don't have to pay any interest, but that $65,000 is gone. You're never able to control it, and it's never able to grow for you ever, ever, ever again. And so the problem is over 30 years, that one car decision costs you over $280,000. It's $280,000. That car, and I just want that to land. You remember, you didn't just purchase that car, but you lost the $65,000 of what that could have earned you over your lifetime. Now, what's interesting, someone like me, I'm planning on living for another 60 years. That one car decision would have cost me $1.2 million, only assuming I could earn 5%. Now, I want to be very clear that I write in my book the importance of control. I believe control for me is far more important than even compound growth. And I talk about how you can actually maximize both compounding and control. But essentially, let's say over 30 years, just by controlling my money as an entrepreneur, I can make 9%. Now, I'm talking to entrepreneurs that are earning 60, 70% on their money because they know how to use it, they know how to market, they know how to invest. But just 9% over 30 years, that's $862,000. And over 60 years, that's, oh wow, that's not, I did that wrong. Over 9% over 60 years, that's 11 million. Now again, it's because consistency over a long period of time. Let's just go back to the 30 years. If you could just double the money that you're making, 10%, now you're talking about $1.1 million over your lifetime, or over 30 years. And that's just an example of compounding. That's an example of control. So my big problem with paying cash is the plus, I'll do here. The plus is no interest. I'll write that in here. The minus is you're giving up, let me go back. You're giving up control. and you're giving up growth on that money. And for that reason, paying cash, I would pay a little bit of interest to have control and growth. And this is interesting because when you think about opportunity costs, you have to think about it in the function of long-term growth, short-term control. If you're an entrepreneur, if you're someone that's like an investor, control is going to be more important to you than compound growth, because you're investing in yourself. You're able to take $1 and maybe double it. If you're someone that's working, that's high income earning, that's like working at a job and investing in a 401k or whatever, you have to make the determination as, do I actually believe that my money can grow? Is the market set up in a way that can grow my money? If the answer is yes, it's like, what would that look like? And that's how you need to make that decision. Number 2 is using leverage. This is essentially, invest the difference and then use the bank. And so let's talk about the problems of using the bank first. Is you take a $65,000 loan, let's say you get approved, that's definitely a factor, and let's say over 60 months, I'm just using this calculator down here, the payment calculator, let's just say you can get a 4% loan. Actually, let's do 5%. 5%, you have a payment of $1,221.54. If you go here to this calculator and put in $1,221.54 and you multiply it by 60, that represents the monthly payment over 5 years, you have $73,292. Essentially, the over 5 years of taking a loan from the bank, you are not only paying for the Tesla, $65,000, but you're paying $8,292 in addition. This is the interest. This is, I talk about in my book, the control cost of using someone else's money. Now, again, what people will say is that's a problem because that's extra money that you're paying. And for me, I go, okay, yes, but now my $65,000, I have control over it. What could I do with that? And I could grow it. Let's just assume for the moment that you could have $65,000 over, let's just say 5 years, over let's say 5%, same interest rate. That $65,000 would grow to $82,000. So just by compounding your money at 5% over 5 years, not touching it, not controlling it, the money is growing more than what you're even paying total over 5 years. Now, that's not a complete apples to apples scenario because you have a payment in this scenario, but it's like a lot of people when they look at that, they're like, oh, I would make the payment for 5 years or 60 months and my money, like what I'm paying the bank and principal, is less than what I'm earning, and that's over just 5 years. Remember, you're creating a machine that's continuing to compound. So the compounding side or the growth, it's just like, number one, you can see like that's over 5 years. What about over 10 years? It's 105. Over 15, it's 135. Over 30, it's 280. The reason I think compounding is so amazing is just at these numbers, it's really, really powerful. And I'm using 5% because if you look at the And Asset, which is a book that I wrote, which is it's using a special type of life insurance. I know a lot of people hate life insurance, and for the most part, life insurance is a terrible place to put your money. But if it's set up and used properly, it's overfunded, it's maximizing the cash. It's actually a phenomenal place to grow your money. And when you look at, the after everything, when you look at the internal growth rate, the actual growth rate of these policies, you're growing your money at 3.5% to 5%, and that's after taxes, after that's after everything. And so it's like you would have to factor in taxes, fees, the cost of insurance, and a lot of times you have to earn a lot more than 5%. The reason why life insurance for me is so valuable is I get to control that money. So a lot of people would say like, oh, you can grow your money, but you can also have a guaranteed access to control it and buy whatever you want. This could be a car. This could be, a business, an investment. And so for me, the control aspect, it just depends. Everywhere where you put your money, if you put your money in a 401k, you have less control. If you put your money into an And Asset, you have way more control. You put your money into just an index, you're off somewhere in between. Like you have more control, but if the market drops, you definitely have access to your money, but it could be putting you in an interesting situation. So leverage gives you, yes, the negative side is you have to pay interest, but that interest gives you the ability to grow your money and better control it. Now, what a lot of people will say, and this is kind of the beef that I have with our industry, especially the people that are teaching about how to become your own banker and all this stuff, is they'll say, oh, you can get wealthy by buying cars using life insurance. And I'm telling you, like, think about that logic. I could say, like, oh, you can get wealthy by buying a Tesla, and here's why. And I could say that, okay, your money could grow in your life insurance, you could control it, and yes, you're paying, you're paying, what would that be? $8,200 worth of interest, but your policy is actually making you a lot more. And I could see, like, hey, see, over 10, 15, 20 years, your money's compounding at a greater rate than what you're earning. Well, that's misleading, because I could also say, would I buy a depreciating asset? Why wouldn't I just buy an investment property or reinvest my money into an index or reinvest my money into myself? That activity would actually make me a lot more money, because the Tesla or the car is a depreciating asset. So yes, this is a better way than cash. Yes, I could say over 10 years I might have more money than what I paid, but that doesn't make me wealthy. That just makes it more efficient than paying cash. Again, it goes back to, I'm not telling you to buy anything. I'm saying if you're going to purchase that, make sure that you're being most efficient. Do not be confused. You will not be wealthy if you buy a car. You will not be wealthy if you buy a depreciating asset. Like, that's not going to make you wealthier. Again, if you're going to buy that, this could be a more efficient way to do that. But don't buy into the lie that it's like, this is going to make you wealthier by buying a depreciating asset. Like, I hear that all the time, and I just want people to start thinking, like, no, because if you do that and you use your and asset, you're giving up liquidity to say yes to X, Y, or Z. Think about that. All right, third way, this is actually the way that I recommend, and if you can pull it off and if it works, it can be a phenomenal way to do this. And it's essentially saying, okay, we obviously, number two is a better way than number one in most cases. It's like you get more growth, you have more control. It doesn't make you wealthy, but it's more efficient to purchase that deal. But if you already have an and asset established and you have the ability to get a bank loan, a lot of people are saying, hey, you don't have any bank loans, just bank on yourself. Again, does not make a ton of sense. And I'm just being real with you guys. Like, that doesn't make a ton of sense, because why would you want to give up liquidity? It's like, this is not a magical thing. Like, this is, if you use an and asset and you use it to buy a Tesla or you use it to buy anything, now you're giving up liquidity. And yes, your money's continuing to grow. Yes, it's more efficient than paying cash. But if another opportunity comes, you're only able to invest. And I recommend everyone having an emergency account. So it's like you're kind of strapped for how much you can tap in. What I would recommend is if you could get a bank to give you a loan for maybe even cheaper, keep liquidity, keep control of your and asset, it's still going to grow. And now you have access to capital that you can utilize as well. So the way that I actually did this, and it's just a way to think about it, is I put money into an and asset, and my money grows, and I can control my money. And when I have an opportunity, like an investment opportunity or business or whatever, and I can't get a bank loan, obviously this is access to capital, and I want to be able to use it. Because of the car, and it's very common to get car loan, I got a Tesla loan quote for I think it was like 3.7% interest. So right now I got cheaper money. Let's just do that. $65,000 at 3.7% over 60 months. It's $1,184. Let's actually do that. $1,184.64 multiplied by 60, 71,000. So I paid over 5 years, and I'm not 5 years into this, but $71,080. So I paid an additional $6,780 over 5 years of interest. Okay, and my money is in my and asset. It's continuing to grow. It would have grown regardless, but I'm able to control that money and say yes to opportunities that are going to earn way more than 3.7%. Way more than 3.7%. We're talking like in the process of doubling my business, in the process of, saying yes to other investments. And so I wanted to keep more control in this scenario. So again, I'm looking on the screen. I know there's chicken scratch. Hopefully you followed along. But number one, paying cash. Paying cash it's convenient. The problem is, number one, your money to pay cash, it's obviously sitting somewhere that's probably not earning you a ton of interest, and then you give up control and growth. Using your policy as leverage, essentially you're putting your money in a place and then you're borrowing against it. This could be, an and asset where you put your money in, it grows the rest of your life, you can borrow against it, and a lot of people use that to buy cars. That's great, that's fine, but I've just found that if you can use the and asset and combine that with a bank, and usually that gives you more growth, more control, and just so you know, the policy doesn't grow anymore, but it gives you the ability to control your money so that you can grow it more instead of buying a depreciating asset. You can buy something else. I just want to clarify that. Your policy will be the same regardless whether you borrow against it or not, if it's with the right company. So there's the example. Hopefully that made sense. I'm continuing to get better with these videos, and I just want people to start thinking as it relates to every decision you make has a consequence. And again, I feel like a broken record here, but we want people to understand that money is a tool. Loans can be a tool. Any financial instrument can be a tool to better live your life. And if you don't have clarity on what that looks like, that's more important than figuring out the best way to buy a car, because maybe you shouldn't even buy a car because buying that car might not get you closer to where you want to go. So you can find out more at betterwealth.com. You can get my book. You can listen to more episodes on YouTube or on the podcast. I'm continuing to make content because I know that this kind of stuff will help people think differently. We're all about thinking differently at BetterWealth. Take care, be well, and if you like this video, please let me know. Give a thumbs up and share it with people that you love. Thank you so much for listening to the BetterWealth podcast. It would mean the world to me if you could hit subscribe, leave a review, and share this with the people that you know and love.